Okay, well, I guess that should do it, Michael. Perhaps we should get the program started. Good afternoon, ladies and gentlemen. And on behalf of the University of Victoria and CFA Society of Victoria, I'd like to thank you for joining us this afternoon. My name is Christian Mattinley. I'm the president of CFA Society Victoria, and it is my pleasure to be working alongside Dr. Michael King and Rudy Narvas as we work through what should be a very engaging presentation this afternoon. And to hand it over to Michael, I'd like to first offer a very brief introduction. Dr. Michael King is the Associate Professor and Lansdowne Chair in Finance at the Gustavson School of Business, where Michael has developed an interesting niche in the digital marketing and financial services technology area that is continuing to emerge and always has interesting insights to provide in that regard. And with that, Dr. King, I'll turn it over to you.
Okay, well, thank you very much, Christian, and welcome everyone to our final Uncharted webinar, Uncharted Waters webinar of the year. So Gustavson School of Business actually launched this public seminar series at the start of the pandemic to try and bring knowledge and expertise from our speakers to the Victoria and the Vancouver Island communities. We're particularly happy to be partnering with CFA Society of Victoria for this event because it illustrates the close partnership we have between the university and the local financial community. Before I continue, I'd like to acknowledge with respect the Lekwungen peoples on whose traditional territory the University of Victoria stands, and the Songhees, the Esquimalt, and Wasanich peoples whose historical relationships with the land continue to this day. I would encourage all of you to take a moment to consider where you are currently located and the relationship of local Indigenous peoples with the land. Before I introduce today's speaker, I want to launch a poll so that we can learn a little bit about each of you. The poll has 3 questions, so you should see it popping up now. Just take a moment, and there's a question about where you're joining from today, what is your profession or occupation, and what is your outlook for the US stock market for next year? Okay. So while you're working on that, I would like to introduce our speaker today, Rudy Narvas. So Rudy joined BCI in mid-2017, and for the past 2 years, he has been Director of Macro Investment Research. For those of you who may not be aware, BCI currently manages over $170 billion on behalf of BC's public sector clients, which include 11 public sector pension funds and 3 insurance funds. So Rudy's job is to monitor the global economy and markets, to analyze both the opportunities for investments and the risks, and to share his insights with BCI's Management Investment Committee. Today, he will also be sharing those insights with us. So Rudy is a lifelong economist. He studied economics at University of Manitoba for an undergraduate degree and then a master's at York University back in the 1990s. And then he embarked on a career as an economist and strategist for the next 20 years. He actually began his career at Finance Canada, where he was part of the debt management team, which is a skill set that no doubt will be helping him in the current environment. And then he moved to the private sector, working in Toronto and New York with TD Securities, the research firm Continuing Economics, Societe Generale, and Renaissance Macro Research, where he was focused on both US and Canadian fixed income and equity markets. So Rudy, thank you very much for taking the time to speak with us today.
Thank you. I guess I have to put my camera on.
Yes, you can.
There we go. Sorry about that. I don't know. I didn't realize I turned it off.
Yes, we can now see you.
Okay, great.
Just a few logistics for our session today for the participants today. So this is a Zoom webinar, which means you're not able to unmute your speakers or turn on your camera. The chat function is now also going to be turned off. Instead, we would ask that you submit questions via the Q&A function, which you may find at either the bottom or the top of your screen. Your questions will be visible to me and the panel, and I'll be able to pass them on to Rudy. We're going to have a discussion for about 25 minutes, and then we're going to turn to your questions. And when we run out of questions or we run out of time, the session will be up. Okay, and I would just highlight that the session is being recorded and will be posted online after the session. Okay, so Rudy, let's take a look at the results of our poll today, so you can see where people are calling in from. So 3/4 are from Victoria, with a small number from the mainland and British Columbia, and a few people checking in from the rest of Canada. Predominantly in financial services and business, although we have a few people from academia. And it looks like almost 60% of participants believe that the US stock markets are going to continue to go up, with only a few, well, a significant, 25% believe that they will go down next year. So that's where we're looking for your insights, because we know that the US and the world stock markets enjoyed perhaps their best month in November since the recovery in April, on the back of the news on vaccines and the outcome of the US election, which we believe is over. How long do you think this equity bull market is going to continue, and what do you see as the risks out there?
It's a good question. On a macro level, over the next year, we're pretty optimistic ourselves about the global growth. It's going to be a tough couple months because of the renewed lockdowns, but the prospects of the vaccine are quite positive, and distribution is quite positive. And given the fact that you also have a $1 trillion US stimulus on tap, that's a definite economic positive, and lots of momentum midway through this year. As far as the US stock market goes, it's an interesting question, because one of the things that we've been calling for is a rotation out of growth into cyclicals. Mm-hmm. And because of this rotation of growth out of cyclicals, you could get underperformance of US stock markets relative to other markets like Europe, like the UK. And it's largely because the breadth of the growth stocks and the influence of the growth stocks within the S&P 500. Typically, in this environment, in this stage of the recovery, you should start seeing yields rise, and with rising yields, that is usually not a very good factor for growth stocks. And you're definitely seeing the reaction in November in that rotation, and that we expect that to continue.
Rudy, do you use growth stocks as synonymous with technology, or is it broader than that?
I think at this point it's technology, given it's like 25% of the S&P 500, right? Pretty much, the FANG stocks. So, and we have to remember too that, when we look at other stock markets, the US stock market is extremely unique because of the heavyweight in growth. Meanwhile, if you look at Europe, and if you look at the UK and Canada, are very cyclically based stock markets. So you'd expect those to perform, and also emerging markets during this sort of rotation. Now the question also too is, what are valuations at, right? And Michael, you and I were talking about valuations, and if you look at forward PEs, 12-month forward PEs in the US and globally, you're looking at very high valuations. And in some cases, 3 standard deviations from the 10-year median or 10-year mean. But markets are forward-looking machines, and at this point are looking beyond the 12 months. And if you look at longer-term earnings expectations, let's say 2 to 3 years, you'll find that current valuations actually aren't so bad. They're in line with history. They're not overvalued, except for the US. And so that's another knock when you come to the US. Is the US going to do well? Well, it might, but it might not do well relative to other countries, which actually use longer-term valuations, have more room for valuation expansion relative to the US. The other thing that we're cautious about is, at BCI we create our own internal tools and indicators that flag events for us, or issues, or risks, or opportunities. And one of our key indicators is something we've built, which tell us the risk of a a large equity market drawdown in the next 12 months.
Mhm.
And it identified the last two well before it occurred. And right now it's signaling it again. You know, and I can't go into details of what's in it, but what it's telling us is that we don't know exactly what's going to cause a large market drawdown. And a large market drawdown isn't your typical bear market of 20%, which people talk about. It's not an arbitrary number. We don't use that. We've created an algorithm to tell us what a large market drawdown is, because it's quantitatively, it makes sense. You just can't use an arbitrary number. So
is there a time horizon for the drawdown? I mean, is it a sharp and shard or an
peak
extended
to trough,
multi-year?
peak to trough. Yeah, it's a multi-year peak to trough type thing. And so it flagged the one in March of this year. It flagged the one a couple of years ago before that. And what it's telling us is not exactly what's going to cause it, but what it's telling us is the market is extremely vulnerable right now. I can tell you, it's not because of valuations. There are other things that are going on. It's a completely macro-based indicator. And normally in situations like this, even though we're very optimistic on the outlook, it may make sense to put some protection in U.S. markets because of what our signals are telling us at this point. You know, we're long-term investors. You know, we could sit through what's going on, any sort of volatility, but you know, any incremental advantage you can get to add value, and that includes to protecting from downside risk, is something that we take into strong consideration.
So we're already getting some questions in the Q&A, and I want to thank the first few people for throwing those in here. One of them is quite related. I'll try and bring them in as we're talking about it. So one of the questions was, are forward PEs really a good way to price growth stocks, given that they tend to be very asset light and they have a lot of intangibles that are long term? As opposed to you know, cyclicals, where maybe PEs have been more proven in the past.
You know, I mean, that's a great question, and you know what, that person is probably right. Is that you shouldn't be judging growth stocks by 12-month PEs, and also maybe you shouldn't be judging the S&P 500 by 12-month PEs, given the heavy weight into growth. And so you can't really compare the S&P 500 today than it was 20 years ago, or less than that, when Exxon was the largest company in the S&P 500. And we have to remember that not even that, even 15 years ago, Exxon and the financials were the biggest companies. It wasn't the FANG stocks by any means. And so you can't, it's no longer apples to apples. And I think you're right about that. Part of it is also, I think, understanding, but the problem with valuation is, how do you value tech, right? And one of the things, and we talked about this, Michael, is like, it's almost impossible, right? But as market participants, we try to, and as a result, sometimes we're wrong. And there are certain valuation methods which suggest that things might be a little bit out of whack, but it's also because we just don't have an understanding of these intangibles. Like if you look to the price to tangible book value of non-financials, it's insanely high, because what's happened is that a lot of the book value is now in intangibles. And how do we price those intangibles? It's hard to say. But what's also interesting is that when you look at the composition of those companies with high price to tangible book value, it's not just tech companies. It's actually a wide array of companies, from cosmetics to Pepsi to Merck. It's a wide range of topics. So a lot of companies are actually booking intangibles. Whether that's right or wrong, it's difficult to say. I'm not an expert in that.
This is a subject that some researchers have been looking into, because one thesis during the COVID pandemic was that high ESG stocks were outperforming because they proved to be more resilient. But it turns out that many of the high ESG stocks also are high intangible stocks with high cash balances. And so there seems to be a sort of that triumvirate that seems to be really identifying highly resilient stocks. There was a question about your comment about the drawdown. The drawdown that you were talking about, is that US focused or is that a global drawdown?
Well, we tend to focus on the US because everything else follows after that. You know, as an economist and strategist by trade, you tend to focus a lot on the US because of the wealth of data which is available to it. And the fact is that the US is a global hegemon. And if something goes wrong there, everything else will go wrong. Then you just play a relative value game, you know, who will do better than the US under certain circumstances. And that's sort of, you know, what we try to do.
Well, speaking of global hegemons, I mean, maybe it's a good moment to jump forward because, you know, well, let's talk about the US.
Okay.
So we do have a president-elect, and President-elect Biden has started to appoint his economic team, and we do see former Fed Chair Janet Yellen as his new Treasury Secretary, and the current Fed Chair Jay Powell's term will continue until 2022. So there seems to be some not only great experience, but also some near-term consistency. But what do you see for the US in terms of both fiscal and monetary policy in the coming year? You mentioned a $1 trillion stimulus. Is that going to be it?
I think I guess it depends on who wins the Georgia Senate race, and it's really dependent upon that. And we won't know until January. But right now, the baseline is that $1 trillion stimulus, which is, you know, probably a third of what the Democrats want, and maybe half to a third of what the Fed wants. And if we look at the stimulus package in the US, it's mostly geared towards consumers, households, I mean, and the unemployed and small business. And there's nothing wrong with that. But the larger stimulus was actually was a more interesting prospect in the sense that it was looking at spending in infrastructure and green, which were longer term investments would actually be positive for potential growth in the US in the long run. So a lot of these measures are very short-term band-aids, but the more promising thing for us was a potential for infrastructure spending, which isn't going to happen, and it can only happen.
Why will it not happen? I mean, Trump actually campaigned on it in 2016. He didn't deliver. Biden has mentioned it as part of the green recovery. So why do you think it's not going to happen?
It's funny because, you know, as a Canadian, we don't really understand how U.S. political system works, right? And I don't. And so whenever I talk to a pundit or one of our advisors when it comes to U.S. politics, the answer is always almost the same: is that infrastructure is something which is almost dead in the water in every cycle. It's a very difficult thing for parties to agree on, even within parties. You know, you didn't see the U.S. try and spend money during the first part of Trump's campaign, Trump's presidency on infrastructure, even though they had control. Instead, they built a wall, right? You know, and the structure of which is basically how they reason why they can't decide. Did they set up an infrastructure bank or anything like that? So when I talk to my friends who are you know, more plugged into DC and have been doing it for decades, the answer really is that it's something that is likely never going to happen, or not going to happen unless you get a Democratic sweep. So we're not banking on that at this point. The larger issue for us, really, when it comes to the U.S., when it comes to the spending and the deficit and the Fed, et cetera, is that, you know, is the impact it has on the U.S. dollar. And right now, we are very much in the view on the side of a long-term U.S. dollar depreciation cycle.
Yeah. Mm-hmm.
And this is and this has to do with the current account and the deficit projections in the United States relative to other countries. And we're seeing, and also the fact that the Federal Reserve is starting average inflation targeting, which by default should push down the US dollar. either through purchasing price parity or just through real interest rate differentials. If other countries don't pursue the same strategy of targeting higher inflation with low rates for an extended period of time.
So a US dollar depreciation, is that net positive or net negative for the US economy?
That's actually an interesting question. You would think there's different ways of looking at the US economy from my perspective. And I think that the US in general is like a large closed economy, right? That's how sometimes you want to view it. Sometimes it's an easier way to view. But the currency does have an impact, and it does have an impact on what do you call it? On corporate profits. Specifically corporate profits. And you see this happen when it comes to earnings, and also that the currency makes a huge difference for US companies. It may make US exports more competitive, but it really depends on what, when you think about what does the US really export to other countries, right? There's a lot of oil and natural gas, but some of it is capital goods, which are not as sensitive to changes in prices because these are things that people need. I mean, there's not many places where you could buy a Boeing airplane, right, or something equivalent to that. And so these are less sensitive to fluctuations. So, I think that in some ways, as a whole, a weaker currency for the U.S. is positive, and a weaker currency in the wider prospect is actually a signal of a positive global environment, because it means that it is a risk-on environment in general, and you see that in the way commodity prices are behaving, for sure.
Yeah, well, we'll get to the risk on and the search for yield in a moment. But before we do, I want to talk about the other hegemon. And here I'm thinking of China, not Canada. So the economy actually in China has grown strongly through the pandemic in 2020. And forecasters such as the IMF are calling for over 8% growth next year. So what's your view on China's economy, and what are the geopolitical risks that we're watching, particularly the relationship between Biden and Xi?
It's interesting because we had a talk with a China analyst a couple of weeks ago, and it was a really good talk. And what surprised us about China is that China has been able, whether you believe the numbers or not, it's like, do you believe the polls? I don't know. But for China, was fascinating is that they were able to pull off this V-shaped recovery and a very strong recovery with very little stimulus, very little monetary stimulus, very little fiscal stimulus. If you look at what we have this measure, what we call the credit impulse in China. And the credit impulse for us is we use it as a measure of monetary policy or the amount of monetary policy. And initially there was a lot of stimulus, but it's been pulled back significantly. And normally when you pull back the tap on credit, you'll see the economy begin to stumble, but you're not seeing that in China. And the fact is too, it's that you're not getting any fiscal stimulus whatsoever, which is helping, offset the lack of credit growth. Now, what's moving that is difficult to say. There aren't any clear answers, but we do know that the Chinese economy, through other data, non-Chinese government data, is actually doing quite well, and that you're seeing other pieces of the economy, like the consumer, as well, start picking up the pace.
So it's not just export-led growth. There's also signs of consumer spending that's really, it's been anticipated but hasn't really shown up.
And it's starting to show up, and that's the thing. You're right. And so, we're fairly positive in China, and there's still and what has us hopeful too is that there are still signs that there is acknowledgement that that they have to keep a close eye on the financial sector risks,
Mhm.
particularly because of the elevated debt levels, and that's one of the reasons why they cut off the
Ant
credit
Group.
tabs. Pardon me?
Ant Group's IPO may
Yeah, well, exactly.
tripped over that. What do you think about the? I mean, that's economics, though. But what about the politics between between the Biden and Xi? I mean, do you think that Biden is going to continue with the kind of the trade war, the restrictions on Chinese companies listed on U.S. stock exchanges that's been floated recently? Do you think he continues those policies, or what do you think?
I think that he's going to continue those policies. Very little is going to change on that front whatsoever. I think what we have to remember is that even though not Democrats did not get along with Trump whatsoever, Democrats did, actually quietly supported Trump's, I guess, Trump's position against China, and they weren't as vocal when it came to the trade war and the trade negotiations as they were on other topics. We also have to acknowledge that, given recent actions in China Hong Kong over the past year, there has been widespread from Republicans and Democrats condemnation in the Senate, particularly almost consensus that when it came to condemnation. That's not going to change. The approach will change possibly. Biden is looking to get the allies on board to do something, but there is real reason for them not to return to the pre-Trump days, because that wasn't working whatsoever. I think there is acknowledgement that China's entry into WTO, the way it was done and the way it's been executed, has been a mistake. The China that wanted to join the WTO and under the rules at which they were given and what they said they were going to do is very different than what they are today and what they've been doing. Whether you say this is the end of, we're past peak globalization, that's probably true.
Yeah. So well, if 2020 was the year for a health crisis and an economic crisis, do you think that the risks are really going to come from politics in the next year? I mean, it's already starting. We're seeing the brinkmanship between the UK and the EU. China, US could continue. If economies are recovering, is it really up to politicians to stay out of the way, or do you think they're going to?
I don't think politicians can stay out of the way. I think it's not within their nature. It's interesting. I mean, when I started in this business, you didn't spend a lot of time talking about politics and geopolitics. I mean, a lot of it were one-off events where there was a war or something like that, an election, but it was never a constant. It wasn't constantly hitting you in the face, and that's I don't expect that to change because a lot of the bigger issues haven't been resolved, and it won't be resolved under a Biden administration. And when we look at, there's China, the US, you have UK and Brexit, but then we also have Iran. And we really don't know what's going to happen with Iran. If you go around and you talk to people who know more about this than me, the risk of some sort of full-scale conflict with Iran is a lot closer than people think it is, at least under Trump. Whether it's closer under Biden, we don't know, but we're pretty damn close. And all it needs is a mistake to be made by one side or the other, which did happen when Iran killed some U.S. troops in Iraq with rockets by accident. And that's what caused the U.S. to retaliate by killing that general. Little mistakes can cause bigger problems if not handled correctly. And I think that we're definitely still in that state.
So political risks or political events could be the catalyst for the drawdown that you're looking at.
It could be, or the vaccine is not as successful as we think it is.
Yeah.
And people don't take it, right? And I think it's really the onus of people to take it. And I understand the fear that people have, and it's real because it was pushed by so fast, and we don't really know the true long-term side effects. Maybe I got that third eye I've always wanted, right? But
So let me
you know,
let me bring it back to closer to home, because we haven't talked about Canada at all. And even though we had the economic statement last week from Minister Friedland, she promised to do whatever it takes to help Canadians through the crisis. And
yeah,
as a former debt manager at Department of Finance, you know that the debt level has increased, and it's supposed to plateau or stabilize at around 58% of GDP
yeah.
in 2 to 3 years' time. What's your outlook for the Canadian economy, and what about the debt overhang and its eventual repayment?
Well, you know, I think we're fairly positive on the Canadian economy. I think that, um, you know, regardless of the political consequences of running up the debt, um, the fiscal authorities, you know, in most Western countries have done the right thing by offering large fiscal packages, because monetary policy is limited in what they can do. And so there's been this emphasis prior to COVID-19 for more fiscal policy in periods like this. And I think we were pleasantly surprised that the fiscal authorities did react in this way, and especially in Canada. And you know, the extension of the CERB and all the other programs will create this nice bridge before, you know, we get closer to herd immunity. When we look at the numbers at which, or the projections of when the Canadian population will be inoculated, it's pretty impressive. And you know, we could expect 3 million people to be inoculated within the first quarter of this year, and 50% by May. Those are big numbers, and I think that the government has played its cards really close, and really haven't revealed much. But you're seeing more and more that they're maybe more prepared than a lot of people realized. And so this is very positive for the Canadian economy. It's positive for the second half of this year, and people will have money to spend. The question is how long can small businesses last under new restrictions? We don't know the answer to that. We do know that it's very painful. We see the high frequency data coming from some of the new data providers. In the US, it's not good. In Canada, I've been to New York twice during COVID. I have done my 14-day quarantine, so I've done my response, but I've been to New York twice. Very different place than here. Very, very different. You know, my favorite stores and restaurants, a lot of them shut down. Here, most of my favorite restaurants and stores are still open. I think that Canada is in a good place. We had a very good, responsible government that understood they needed to go big in order to protect the economy and also ensure the safety. On the other hand, the longer term issue of the debt is real. And I think we are more concerned at the provincial level than in the federal level. The federal level is a different animal because, you know, you do have these closer ties with the central bank. But at the provincial level, we're a bit more worried, given where the revenue streams come from, and what you're seeing with the potential damage, and whether or not they will be able to come out of it. So, you know, this is, I'm not saying it's similar to the 1990s where you saw austerity, but austerity could be around the corner in parts of Canada easily.
Yeah. So I think you've answered my next question, because I'm going to jump to like one of the elephants in the room, which is this idea. People are quite divided on the outlook for inflation, because one side in the central banking community sees a risk of deflation and is trying to avoid that using this fiscal stimulus and quantitative easing. But a lot of people are sort of looking at the risk of hyperinflation because they see governments around the world printing money. So where do you stand, and what's the risk of one side or the other?
I am of the view that inflation will stay low, and there are a few reasons for this. I know a lot of people who talk about hyperinflation or higher inflation, they tend to talk about, as you said, talk about the printing of money. They also talk about the Phillips curve, etc. My view of what the whole printing money argument is that, well, the issue for me is that the quantitative easing really started at the GFC, and we did not see that hyperinflation that everybody was worried about. And there are a couple of reasons for this. And some of the reasons I look to are more, what is inflation and what drives those components of inflation? In the US, if you look down to the core inflation, some of the biggest components of core inflation have little to do with what we consider, are influenced by the Phillips curve. Some of it is influenced by policy, and that's healthcare and healthcare services inflation in the US, which is the largest part of core PCE inflation. The housing owners equivalent rent, that's another thing. Other things are more influenced by FX goods. So it doesn't leave much in modern inflation, modern pricing, for the Phillips curve to have an influence. And one of the more interesting things that I was part of Bank Canada hosted a forum on to discuss new ways of approaching its monetary policy and inflation. And one of the things that came up from one of the Fed researchers was something which a few notable people for the Bank Canada agreed with and thought would be an interesting idea, is the live experiment that the US conducted in 2010 during the past 10 years, and that is to see how low you could push the unemployment rate without causing inflation. And they pushed it pretty damn low without causing any inflation. Mm-hmm. So the view is that possibly the Phillips curve is extremely flat or dead. I'd say it's just flat. It's not completely dead. I don't want to take the chance that if it does emerge, I'm on the wrong side of that. Mm-hmm. But my view is that it is flat, and at least we're at the flat part of the curve, and we have to push we may have to push the economy further to get that inflation we need, especially in the U.S. In Canada, it's a different story. Inflation expectations and inflation is average inflation closer to the 2%, but we are at risk of being below the 2% midpoint of the 1% to 3% band. And that's why the Bank of Canada is looking at different strategies at achieving it. And that's also why the Federal Reserve adopted average inflation targeting, largely because to raise inflation expectations, but also to make up for economic loss due to, and that's probably one of the bigger reasons, the economic loss by just stopping at the 2% target rather than going over and making up lost ground.
Yeah, I know. In both Canada and the United States, they've been undershooting the inflation target. And I guess they're both coming to the view that a little bit of overshooting to offset it might return prices to the same long-term trend, but help to boost employment. So for non-economist wonks, Phillips curve is looking at the relationship between inflation and employment. But do you think that we're now, although it's evident in Japan and Europe that we have negative nominal interest rates, not to mention real interest rates that have been negative around the world. Do you think that we're going to see negative nominal interest rates in both Canada and the United States in the coming years?
Yeah, that's a question we get. I get a lot, and my answer to that is, at this point, no. It's not our base case, and the rationale for that is not because we don't think it's possible, but it's because the central banks have told us no. The Bank of Canada has said that negative rates is a tool that they have, but they've also said that that they're not sure of the efficacy of it, and the Federal Reserve is in the same boat. Part of it is a structural reason of the structure of the financial system, where negative rates may not work the way they want them to, and need legislation to change certain aspects of it. But part of it is also looking at studies of what happened to other countries who adopted negative rates, like Japan and Europe. And there was a study by the San Francisco Federal Reserve which looked at this, and it was fascinating because what it found was that while negative rates were positive for the economy in the early quarters, on a longer term basis, it was a net negative. And it largely had to do with the impairments it caused to the banking sector. So if you're going to do negative rates, you have to think of doing it in a way, and maybe changing legislation, which doesn't actually stop banks from lending. And part of that is ensuring maybe that the yield curve in some ways isn't flat and somehow steepen it. I don't know what the answer is to that, but I think there's recognition within the Bank of Canada and also the Federal Reserve that, well, until we actually really have our backs up against the wall, or we find other ways to make it work, negative rates is an option at this point, at least nominally.
Okay, sort of related to this, there's a couple of questions that have come in through the chat about the high savings rates that we have, or the high cash balances that are evident in the economy, because Minister Friedland has talked about unleashing these savings as part of the government's recovery. Others are saying that consumers have been stockpiling a lot of cash and savings. And now potentially as we come out of the pandemic with vaccines, those are going to be, do you see those being invested, or do you see them just being held in bank accounts as precautionary savings going forward?
You know, I think that there are two things here. Is that, so what happens in the medium term, or short to medium term, what happens in the long term? In the short to medium term, I think when people feel better about spending their money and getting out there because they've been inoculated, you are going to see this pent up demand, of course. And we did see it in the spring. We'll see it again, probably in bigger force, because people want to travel and do other things, or go to, you know, baseball games or whatever that they haven't been able to do. And so you'll see people drawing down on savings to do that. The question is what are the longer term implications of COVID on savings? And historically, when we've seen pandemics, and this is when you look at data going back to the 1400s, this is like almost crazy conspiracy theory stuff, but it's real data. And people have been able to track track economic behavior post-pandemic. And the one thing that they saw, which is, you know, pandemics is what makes pandemics very different than wars, is that post-wars, you saw real interest rates rise on a sustained basis. On the other hand, post-pandemic, consistently, real interest rates were negative for decades afterwards. And part of that is the fact that people enter pandemics, this is my view, and it's in the paper too, is that when people enter pandemics with not enough savings, and you kind of exit with feeling, well, you know, I could spend part of my savings now, but, you know, I don't want to be caught flat-footed again with nothing in the bank. And this is kind of what happened after the GFC as well. You've seen a secular rise in the US savings rate. That part of that is deleveraging, but that deleveraging was because has gone into savings because people don't want to be caught again doing in the same situation. And so, if anything, our view is that we could see on a longer term basis the US savings rate continue to be elevated or to rise post pandemic after that initial drawdown because of the pent up demand. And this has implications for the US economy because it could also mean lower consumption, which is also could mean lower fixed income investment and lower potential growth. And this is why you need something to be able to make policies that make people confident that they don't need to save. And that's not evident yet. You know, human behavior is human behavior. And when people get scared, they tend to save more. But this time can be different. I don't know. But after every pandemic, this has been the case. So we're going to bank on that one for now.
You made a quick Reinhardt and Rogoff mention there. This time is different. All those savings, though, people could either put them under their mattress or put them in a deposit account at a bank and not earn any interest. But a lot of people who are looking at alternative investments, and a couple of them have come up in the chat. So gold or cryptocurrencies. What are your views on those as stores of value or places to put your excess savings?
I mean, so I don't see gold as an investment myself. I you know, coming from
Not
where
even
I am,
an inflation hedge.
I think it does well because people believe it does well. And as an investor, you shouldn't go against the market and what the market tends to do. And part of that is during periods of crisis, you want to be able to you want to buy gold, right? But I mean, what are you going to do with it, right? I mean, you can't do it. The key for me sometimes is that there is no internal rate of return for commodities and gold. So is that truly investment? No. But is it a hedge? Yeah, it could be a hedge, right? Against risks. So it's not a long-term hold for me. If you look at the performance of gold over a long period of time versus CPI, it's not a good hedge, right? So a long-term hedge. So it's really a tactical thing, and it's liquid enough that you could trade it. Part of the issue of whether or not to continue buying gold is, you know, what is driving gold, and gold, I think, is can be inflation hedge, but the issue for me is what's driven it in the past year or so is not just the rise in inflation per se or inflation expectations, but also the decline in real rates,
Mhm.
long-term real rates. And there's been a definite correlation between long-term real rates, i.e. 10-year tip yields and gold. And the question is how much further can real yields, long-term real yields fall? I'm not convinced that it can fall much further.
Yeah.
You know, just given the way the forward curve is and the way it's priced and our expectations of Fed policy, it can't go much further. I mean, you could move down maybe another 10 basis points, but it's not going to be 20 or 30, like the big move. Right now, it's like minus 80 basis points and minus 90 basis points. I don't think it can move. Actually, it was minus 90. I can't remember. Anyways, it just can't move further lower unless the Federal Reserve decides, well, we're not going to raise rates till 2028.
Yeah.
The math doesn't work out. So you do have a limit, I think, on gold. On cryptocurrencies, I think you're the better person for this, Michael, not me. I don't spend a lot of time looking at cryptos because we don't invest in them.
Yeah.
It's not within our portfolio.
I will say that I think that Bitcoin is a speculative instrument with you can't really use it effectively to buy anything, and it serves very little purpose other than for people to gamble in it. Because the original purpose of it was to provide an electronic money that could be transferred easily, quickly cross border, and that use case disappeared. So there's potentially other stable coins that may be fulfilling that, but they haven't really reached a lot of uptake yet. What about longer term investment challenges that we haven't really talked about? I mean, coming out of the pandemic, does the pandemic, I mean, people talk about how the pandemic changes behavior. Obviously, some industries are going to suffer for many years, but are there any kind of longer term challenges outside of North America or globally that you're thinking about?
Yeah, I think there are a couple, and part of it is, you know, the measures taken by fiscal authorities, monetary policy. Is also it was a blessing and a curse. It really helped in the short term, but the issues it has caused longer term are some things things that we're looking at, and part of it is you know, the Federal Reserve and the Bank of Canada's policies towards credit. And what the Bank of Canada and the Federal Reserve have done have declared a floor on credit. And to me, that's problematic. Also, the low rates forever is an issue from a longer term economic and also a investment perspective, because by keeping rates low and also providing a floor for credit, what you end up doing is you end up fueling the number of zombie companies out there.
When you say floor for credit, you mean that there is always some credit available, even if it's not from the private sector, it's from the public sector?
What I mean is, sorry, I mean credit markets.
Yeah.
So high yield debt, investment grade. Essentially, they've said that we're not going to let things, you know, a market as a whole go bad by providing facilities to support investment grade. You know, don't let triple Bs fall into double Bs, things like that. You know, the impact of those policies by the Fed were immense, but it also tells the market, it gives them the green light that the Fed put is pretty big, and they're going to use it. So let's have a party. Now the issue for us is that low rates policy, et cetera, has likely resulted in increase in zombie companies. And the data we've seen in zombie companies since the US started QE in 2007, 2008 have, you know, as a percentage of US companies, it's moved from 5% to 20%. It's quite large. In Europe, it's even larger. So what you have is you have a lot of companies in the US who are barely getting by, but being able just to pay their interest expense. And this is, you know, there's just a lot of liquidity out there, a search for yield, so they're able to roll over their debt. So what this also means for me is that because these zombie companies are such a larger part of the global economy, it also means that capital is not being allocated to the right people. And so capital is going to companies who are just trying to stay alive rather than companies who are going to grow and add value.
Mhm.
So from a longer
This is
term
the
perspective,
problem with the Japan trap.
absolutely.
They kept those banks and real estate developers alive, and it led to the no rise in GDP out of Japan for 2 decades. Yeah.
Absolutely, and we could definitely be in a place like that. It was funny. I was in Denver this time last year, and I was at a dinner sitting with the former Federal Reserve governor, and I mentioned, I said, I said I kind of miss the business cycle, like the real business cycle, because bad companies go under.
Mhm.
And he said he was completely offended by that I would talk about wanting to see companies go bankrupt. But I'm like, for me, that's just the naturally how things work. It's it's terrible, but good, bad companies should not exist because
Yeah.
they're a drag on growth, really, in the end, or potential growth. Um, so that's one of the bigger issues that we want to look at, is like, what is the impact of zombie companies on investments?
Mhm.
Because it does lead to lower expected returns in the future, and then it could also lead to higher higher volatility, because it becomes a balance sheet issue. And when balance sheets become an issue in markets, then you tend to see higher volatility. At the same time, too, we expect, because the central bank put is so strong or so big, that cycles could be longer, but when they do correct, they could be correct extremely very violently. But if we look at March as a benchmark, March, April as a benchmark, things can move back pretty fast. So
Mhm.
you have to be extremely nimble as investors to be able to take advantage of it, because most investors were not nimble enough to buy the credits, right? That we're able to give them a great 20 to 30% rate of return.
Yeah.
Um, so we have to be cognizant of these sort of things. And some of the other longer term issues that we look at is that we could be entering this period uh, of extended lower expected returns.
Mhm.
And I think if you look at JP Morgan Asset Management, all the big companies which do these sort of long-term capital market assumptions, we are moving into the period of lower expected returns when it comes to things
For
like
longer.
equities and
Yeah.
bonds too, everything. And that it becomes an issue for institutional investors like ourselves, who have hurdle rates of 6.5%. If you can't even meet that with equities, then you've got an issue. And for us as Canadian investors, I mean, it's not really an issue for us. I mean, we're doing quite well, but we also have to factor in the Canadian dollar. And if we're also in this period where we see the secular appreciation of the Canadian dollar versus our main exposure, which is US dollar, you could potentially knock off, 100 to 200 basis points each year from your return because of Canadian dollar appreciation, if you have that view. And then, you may hedge that, but it's going to cost you, a bit of your return to do that. But on a longer term basis, I think low rates and low yields are an issue
Yeah.
as far as in fixed income goes.
Another issue
Sorry.
is that we have 5 minutes left.
Oh, sorry about that.
No, it's been fascinating, but I want to give a rapid fire. There's 4 questions.
Well, let's do that.
with that. So short answers. Okay. Do you have a view on the relative performance or underperformance, outperformance of public versus private equities going forward?
Ooh, that's a tough one.
Are more people going to move to private equity as a search for yield?
I think that you have a lot of people moving to private equity. There's a lot of dry powder in there. The issue, though, is that valuations are getting very close to public equities, and so that liquidity premium, which you're supposed to be able to capture with private equity, isn't there anymore. At least it's not as big as it used to be. So the question is whether or not, in some pockets, yes, it is. If you're big enough like us, you could take advantage of it, but if you're smaller, maybe not.
Or another question relates to the impact of retail traders and looking at places like Robinhood or Wealthsimple Trade, where you can trade for free. Do you think they are having an impact on an outsized impact on the stock market?
I think they're having it. Yeah, they are definitely having an impact in some pockets of the stock market. You look at Tesla, you look at all these other stocks which are retail darlings. The issue for me in the longer term is smart money, institutional money, ends up in the long term doing better. And that's always been the case. Because because a lot of the things out there are very speculative, that a lot of the retail money is chasing. Sure, you're going to have success stories, but then there can be a lot of failures that nobody talks about.
Yeah. Okay, another kind of longer term question is, what do you think the impact of demographics is going to be on the economic recovery?
The demographics. That's actually quite a fascinating question, because it's probably demographics when you're talking about immigration, it's a negative, because we're not getting the same amount of immigration that we were prior to COVID-19. So that in itself is going to be a drag. And when you look at the Bank of Canada forecast, the last monetary policy report, you look at potential growth brought down because of the immigration aspect of it. And it's significant for Canada. It's absolutely significant. So at least in the Canadian context, it's not a good story, but there are other good stories in Canada.
But you're going to see a lot of aging population in Japan, China.
Absolutely.
Drawing down of savings in North America. So is that going to basically just contribute to the low rates for longer?
I think so. I think you're right. I think that demographics are not your friend. Is not friendly to yields. Yeah. and that's definitely the risk. And as asset allocators, you have to figure out what is. And no one's really come up with a complete answer on how to deal with a fixed income portfolio, other than using lots of leverage.
Okay.
In the front. Sorry.
Last question. Okay. So, looking at the Canadian economy and how it's diversified or not diversified, do you think that Canada is going to change its sort of structural reliance on energy and oil, natural gas? And over what timeline do you see that happening?
We would hope so. I think that's the hope. When I was in government, there was hope to move ourselves away from a commodity-based country, or the perception of a commodity-based country. But it's a very difficult thing to move away from, because part of it is perception of people from outside of Canada. Is that the perception is that we are a commodity country, even though, as we talked about before, Mike, Canada actually has a great amount of intellectual capital, but most of it is exported, and we don't retain that value add. The question is how do you keep it here, and keep that value add within Canada? It's an answer which policymakers have no answer for.
Yeah. Well, I think we can all feel good that we are here in Western Canada, and that we are in Canada with our rights and freedoms protected, and great healthcare, and relatively low rates of infection. So, particularly out here on the West Coast. So thank you. It's been a great. I would love to have another talk entirely on climate finance, global warming, and that, but that's not the subject for today. Today was geopolitics and the outlook for the economy. Thank you very much, Rudy, for joining us today and for sharing these insights with us. I don't know if Christian is still there, but we want to thank everyone who's tuned in from Victoria, the local community, both participants from the UVic communities, as well as the CFA Society of Victoria communities. And this recording will be available, will be posted and sent out to all participants tomorrow, I believe, or be available online. So with that, I'm going to bring this to a close. I'm going to give you the one person clapping to recognize the support that we're getting from everyone. And please continue to stay safe, and thank you very much for your time today.
Thank you, Michael. Thank you, Christian. Thank you, everybody, for joining.
Thank you, everyone.
Have a great holiday. Happy Kwanzaa, happy Christmas. Merry Christmas, happy Hanukkah.
Thank you, everyone.